Well, my name is Algenon Cash. I'm the managing director of Wharton Gladden and Company, and we are dramatically different than what you've heard with Kevin in regards to First Tennessee. I don't have any interesting stories about beer taste tests or anything like that, but I did go to NC State. I attended North Carolina State. Last year when I did this class with Bob, I wore a red turtleneck sweater just so I could let everybody know where I was from. So I didn't do that this time to some guys that wanted to jump on me when I was walking out the class here. So I did not study business and I did not study finance when I was in college. I studied computer engineering. I was a computer science major. When I came out of school, it was 2001. How many people knew what was going on in 2001? That was what we call the technology recession. Everybody had spent a tremendous amount of money on hardware and software leading up to the Y2K scare. So there were not a lot of jobs for guys like me who had just spent the last 4 years learning how to set up networks and build local area networks and those kind of things. So when I went into college, you could make a lot of money in computers. When I came out of college, you were lucky that you could find a job. So I did work here at Aon Consulting at Winston-Salem for a few months before taking a position with Solomon Smith Barney. So that was my entrance into wealth management. I worked in private banking for Solomon Smith Barney and also worked in asset management for UBS Paine Webber. I joined this company back in 2003. Now, Wharton Gladden is, like I said, dramatically different than what you would see from a First Tennessee. Anyone in here familiar with investment banking? You heard of that concept, investment banking? Well, investment banking has been around forever. And typically, when you think about investment banking, you think about companies, right? Mergers, acquisitions, taking companies public, doing those kind of things. Well, Wharton Gladden is really similar to a corporate investment banking group, but we only focus on real estate. We don't do anything with companies. We do the same thing. We work primarily with small and middle market business owners. We work with developers, and we also work with real estate investors who want to access the capital markets, either for debt, equity, and we also do some project management services, not necessarily mergers and acquisitions, but we do project management from the standpoint of working with landowners who want to partner with developers to do projects. And we also work with business owners who maybe don't want to go out and finance a building, but they'd rather have a developer come in and build the building, and then they can just sign a long-term lease. Our company was created in 2003, and when we entered the market, we were just specifically working on whole loans. We were a whole loan trader. What that means is we would go into groups like First Tennessee. We'd go work with the bank. Now, First Tennessee, they hold all their loans on their balance sheet. That means all the loans that he originates are held on the books. As you heard Kevin talk about, they actually service those loans internally. So whenever someone wants to pay them off, they call up Kevin and say, hey, can I get a payoff? I need to pay my loan off. It's a little bit different with us. I mean, we actually move our loans off the balance sheet, so they're out in the capital markets. But when we were a whole loan trading, we would go in and work with balance sheet lenders who said, hey, I've got X number of loans, and I need to sell some of these loans so I can raise more capital to keep lending out to more people that need money. So that's essentially what we did. We became widely known as a whole loan trading group here in the Southeast. We did about $1 billion in whole loan transactions. We primarily traded residential and commercial mortgage whole loans, and we also did securitized credit card receivables as well as securitized auto loans. So like, for example, I know all of you probably in here at least have one credit card. Maybe you shouldn't have a credit card, but you probably have a credit card. The way these credit card companies work is when you go out and you go to Abercrombie and you go to Starbucks and you go to Belk and you go to all these places and you charge up that card, yeah, they're extending that credit, but they don't want to wait on the money. So they take all those balances and they securitize them into a bond, and then we actually sell that bond out in the open market so those credit card companies can get their money. In 2004, we recognized the need in the commercial real estate sector that more small to medium-sized developers and real estate investors needed the access to the capital markets in order to efficiently continue to do some of their projects. Now, we're not a great solution for construction loans. Anyone want to take a stab at why we wouldn't be a good solution for construction loans? Any guesses? Well, construction loans are short-term in nature. It normally only takes about 8 months, maybe 12 months, or at the max, an 18-month time period for a construction loan. So it's a very short-term loan. That works really well for a balance sheet lender, somebody that's going to hold that loan on their books, because they don't have to wait too long before they actually get their payoff and get the money. The loans that we work with are going to be much longer term in nature. We typically will structure a 10-year deal, maybe even a 15-year term loan. So we work with properties that are stabilized, meaning that Kevin may actually do a loan for a project and he does it through construction. Once it actually stabilizes, if you heard him talk about some of the projects that he's financed, he talked about how well they leased up. Well, once they lease up and they're stabilized, then they come to a group like ours who then re-underwrites the deal, and we take it out to the capital markets for different lenders to look at. I guess I must have jumped back. We've done about $125 million in multifamily and commercial real estate loans. Most of our capital will come from 3 different sources. We work with insurance companies, so we've got relationships with Nationwide, Principal, MetLife, Northwestern. Now, I was having a conversation with my mom once, and I was telling her about these insurance companies that buy our debt. Most people do not know that insurance companies are one of the primary lenders in our country. They loan a lot of money out for commercial real estate loans. So when you're paying your premiums on your life insurance policy or your whatever policy you may have or your parents may have, they take those premiums. It doesn't make sense to let the premiums just sit there. So they take those premiums and they use your money to invest it out in the market, and they loan it back out for commercial real estate loans. They obviously earn a return on that, and then that obviously helps their fund to be able to grow effectively. So insurance companies are a dominant provider of capital in the commercial real estate market. We also work with what we call conduit institutions.